Hi, good morning, everybody. Hope you're doing well. So, first of all, welcome to our inaugural KMF Reconnect webinar. It's a pleasure to have all of you here today with us. So, for those of you who have been with KMF for a long time, and maybe for those of you who may not be so aware, last year we had the 20th edition of the Khazanah Megatrends Forum. And as we move on to hopefully what will be the next 20 and the 20 after that, we thought, what can we try to do to continue in the service of the objective of the Megatrends Forum, which is to be to spread knowledge as widely as we can based on the things that Khazanah has learned over the years, the people that we speak to, and so on. And so we thought, typically we have the Megatrends Forum later in the year in October. And I think what we wanted to do is also, hey, there's a lot of time between the start of the year in October, naturally, and many things happen to start the year. So for example, last year, Liberation Day was in April. This year, with the issues in the Middle East sprouting up at the start of the year, it might be a little bit too far before we get to talk about them, the Megatrends Forum. So we thought, why not try a webinar series where we talk about pressing issues as they come up in more timely manner, and hence was born the KMF Reconnect webinar. So this is a fully virtual series. I know for some of those of you, I promise you this is fully virtual. There's no in-person thing anywhere, fully virtual. In case you're wondering if you didn't get an invite or the kind, it's fully virtual. And what we're going to do with the Reconnect webinars also have former KMF speakers come back and form part of the overall KMF connection and community to talk about these issues. So we have very exciting speakers who are KMF alumni as well to speak to us. So today, the topic that we have for you is the return of the state. And, everything that we've seen in the past 2 years, for some reason, the market has done really, really well, especially the US markets, even Asia last year. And so in a way, it was like, despite everything that happened, the market struck back. And so this is the return of the state. Now, I'm not trying to do this thing where the state's like the Jedi and the market's the state. No. At Khazanah, we like the market very much. But at the same time, I think it comes to a core theme of KMF, which is on balance between what's happening in the markets and how states are responding. And that's what we're going to talk to you about today. So finally, as we move on to the session, I have one ask of all of you listening today. Please give us your feedback, whether you liked the webinar, you didn't like it, or you thought, hey, maybe it's fine, but it could be better this way. It will help us very much, as this is our first experiment into doing this. You've all kindly volunteered in a way to be our guinea pig, so thank you for that. But we would love to hear your feedback. And so welcome to the KMF Reconnect webinar series. Okay, Reconnect webinar. Whether it's a series depends on your feedback in part. So we look forward to that. And now with that, thank you very much for joining us. I'm going to hand it over to the moderator for today, Khazanah's Chief Economist, Shafizal.
Thanks, Nick. Assalamualaikum and good morning, everyone. Something fundamental has shifted in the global economy, and we are still working out what to call it. For much of the past 30 years, the operating logic was clear. Efficiency drove allocation, markets cleared. You have supply chains which stretch across borders, and capital found its return. Government mostly stayed at the margins, and economic security was largely a defense of foreign policy concern. And the world is no longer sufficient today. The global energy and supply crisis made worse by the instability in the Middle East has made this visible. Energy supply depends on geopolitics. Shipping lanes, semiconductors, critical minerals, and payment systems, they have become instruments of state competition. Here is one way to think about the old model. Countries, they behave less like household with a pantry, and they behave more like there's a supermarket nearby. The shelf, they stayed full, prices remain reasonable, and they know the system can be trusted. And today, the market is still open, but the rules, they are a lot less reliable, and access is more conditional. And this is why countries, they're all now asking what belongs in their pantry and what it should cost and who should manage it. And that is where the state has returned. Governments are choosing where supply chains sit, where industries deserve protection, and where energy system must be secured. Economic security, it has become a category of policy in its own right. We have real budgets, real instruments, and real consequences for the markets. For investors, this changes the return calculation. it's no longer enough to ask where growth is strongest or where valuations is the cheapest. Then investors must now ask which government act with strategic intent and which industrial policies build durable capability and which energy system hold up under duress. And here for middle income economies like Malaysia, the question is a lot sharper. Our model of openness and trade-linked growth, they worked when the world was all for efficiency. Now it's going to work slightly a bit different than when the world is organizing for resilience. And for decades, the dominant question was how to get the state out of the market. Today, the harder question is how to bring the state back without crowding out the market. This is the areas where we want to explore today, and we have two speakers who come at this question from different sides of the table. We have Louis, founding partner and CEO of GovCal. He has spent decades of advising institutional investors on global macro and geopolitical capital flows and portfolio strategies, especially in Asia and China. We also have Dr. Nungsari, chairman of Khazanah Research Institute and Malaysia Airports Holdings Berhad. He serves on the board of Bank Negara Malaysia and a member of key national advisory bodies, including the National Economic Majlis Tinggi Ekonomi M10. Welcome, Louis and Dr. Nungsari. Welcome. Let us begin.
Thank you very much.
Yeah. Louis, we'll start with Louis first. For much of the past 30 years, globalization it shaped how the world traded, invested, and produced. Today, the Middle East conflict is really accelerating all the return of the state and economic security to the center of macro outcomes and markets. How should we understand this moment? Is this a lasting regime change, or could it reverse when the current shock subside?
So first, Malikum Salam, Shafid, and thank you so much for having me. I'm very flattered and delighted to be here at the Khazanah Megatrends. Look, no, I do think the world has changed. To answer your question, and I really liked your analogy of the pantry. In fact, I might steal it for some of my report. Because to put it bluntly, I think we're going through three massive shifts. And you said in your question the past 30 years, I would actually go further. I would say really the past 80 years. Because I think if we look back at the past 80 years, the world that we lived in, the globalization that the world enjoyed over the past 80 years, I think relied on three massive assumptions that have come crumbling down in the past few weeks. The first and perhaps most important assumption was that the U.S. Treasury was the world's most liquid, deep market, and therefore any individual, any company, and any country, whether you were called India, whether you were called Malaysia, whether you were called South Africa or Japan, countries would save and companies would save in U.S. Treasuries because you knew that in a crisis, you could always transform your treasuries into whatever it was you needed. So take Japan as an example. 2011, you get the terrible tsunami. Fukushima happens, and the Japanese government decides to shut down all of its nuclear power plants. And on the flip side, Japan is able to sell its treasuries to buy natural gas, to buy coal, to buy oil, and to make do with the crisis at hand. Today, if you're Korea, if you're Taiwan, if you're India, you might be sitting on billions of US treasuries, but what you need is natural gas. What you need is fertilizer. What you need is urea. And suddenly you can't get access to them. You can't get access to them because we just had a second assumption shattered. So the first assumption is this idea that you can always transform your treasuries into commodities. And right now that's not proving possible. The second assumption I think that is being shaken is the idea that whatever happens, the US Navy is the world's most powerful Navy and controls the world's sea lanes. And therefore, you could always buy stuff and the US Navy would deliver it for you. And now we've had two events in the past 3-4 years. First, the Houthis blocking the Red Sea, and now obviously Iran blocking the Persian Gulf, where all of a sudden the very assumption that the US Navy controls the world's sea lanes has come under attack. And then I think there's a third assumption, which is perhaps the most important of them all, is that for the past 80 years, we could live under the assumption that the US was a sort of benevolent hegemon that had an embedded interest in maintaining the global trading system more or less as it was.
And it didn't mean that the U.S. never abused its privilege and that the U.S. was always, kind and generous. But by and large, the U.S. had this embedded interest in maintaining the global trading system as it was. Now, as it turns out, President Trump has now run 3 separate campaigns arguing for precisely the opposite, arguing to the American public that, the U.S. is not a beneficiary of the global trading system, but the U.S. is actually a loser from the global trading system. And a majority of Americans have now voted for this for 2 out of the past 3 elections. And so I think we can no longer take it for granted that the U.S. wants to act as a benevolent hegemon and keep the global trading system more or less as it is. And I think President Trump said it himself. Last week he came out and said, "Look, we want to act like pirates. We can take over ships if we feel the need or the want." And so I do think that these are very important shifts in our world today. And that regardless of what happens in the Persian Gulf tomorrow, and to the point you just made, everybody will look and say, you know what, maybe I should save less in US treasuries. And to use the point that you made, I need to fill up my pantry. So if I'm a country that needs to import fertilizer, then I need to build a fertilizer reserve. If I'm in a country that needs to import wheat, then I need to build a wheat reserve. If I'm a country that needs to import natural gas, then I need to build a natural gas domestic reserve, strategic reserve. So I think on the other side of this, you're going to see a lot of commodity stockpiling. You're going to see it at the corporate level. You're going to see it at the country level. As you point out, we're going to need to refill the pantries.
Thanks, Louis. Now we move to Dr. No. Malaysia, it has benefited significantly from openness, trade, and integration. Like many middle-income economies, our role has often been to act as a connector. But if larger economies, they are now organizing around economic security and self-reliance, how do connected economies like Malaysia survive and stay relevant?
So thanks for having me. Been around this KMF forever. I think, let's position Malaysia's economy within what was, like Louis said, in the last 70, 80 years. I think we've benefited from openness and essentially from trade, primarily because of commodities and resources, natural resources. And that's driven by scarcity of some sorts rather than by competitiveness. There's some element of competitiveness in steel, audio chemicals, things of that sort. But that's one, we benefited from that. And then also, since the 70s, we benefited from more FDI-driven sort of investments and therefore trade that arose from those investments. And that is somewhat an exogenous thing, which hasn't, even after 50 years, endogenized in some sense, but we benefited from trade and openness. Now, the issue is whether we benefited from integration in a real sense. My point has always been that, integration would be there is integration and from the capital flows point of view, but there's not much integration, say, within the ASEAN neighborhood in the real side of the economy. So I think now that I agree with Louis that the whole architecture of global trade and geopolitics will shift forever, and I'm not quite sure what the equilibrium will be out of this. It sharpens my concern that actually going forward, we have to actually leverage or build the integration, the regional integration much better. A small open economy like Malaysia is very exposed. I mean, we can't really dictate the dynamics that is shaping the new equilibrium. So we have to navigate it within those dynamics, and we have to make some choices, and the better choice is actually to deepen integration. Actually, I think trade and openness and all these things is fine, but integration within the ASEAN neighborhood, if not all 11 heads, the three or four around us, and because I think what this crisis, the last since end of February, are exposed. We are bloody exposed. I mean, we are luckier than Thailand, Vietnam, even Indonesia in a sense. We have surplus. Like, we are net exporter of gas, but on crude oil, we have enough reserves up to maybe June now, and because of that, we are short of the supplies of whatever comes out of refineries, whether it is petrol, diesel, jet fuel, or petrochemicals. And this is real, and it also exposes another weakness in the economy, which is actually food. Our food self-sufficiency ratio is in many things small. Not at 100%. Even staples like rice, for example, we're only at about 60-something%. And then we import all kinds of other stuff, vegetables, fish, proteins other than poultry and eggs. So I think I agree with Louis that firms and countries even will build stockpiles to ensure the continuity of operation and so on. But one of the things we ought to look at, apart from energy and the distortions within the energy market, is also food security and decide what kind of firms Malaysia wants to create. And we must accept the fact that Malaysian firms, based on Malaysian endowments and scale and things of that sort, will not be sufficient as a hedge towards whatever's going to happen, whatever that is. And it's really not going to be what it was, say, last year.
Okay. That gives us a wider frame. So building on that, let's turn what it means for investors and firms making decisions in this new environment. So Louis, investors, they are used to asking where is growth, where is inflation, where interest rates are heading. But in a more state-driven world, government choices are becoming part of the investment case. Which sectors government is supporting, which risks they absorb, and which supply chains they secure. How should investors update the framework within this new environment?
Great question, and not an easy one to answer. So if we were between growth, inflation, and rates, I think perhaps where I would say we're going to have the most visibility is likely to be on the inflation front. And on this case, I really like the quote of a French economist called Jacques Rueff, who said that inflation is subsidizing expenditures that give no return with money that does not exist. And I think on the other side of this crisis, what you're going to see is a lot of countries having to review their defense spending, and already in places like Europe, but also in places like the US, you have a US government that is now saying, you know what, instead of spending $1 trillion on the military, we're now going to spend $1.5 trillion per year on the military. When you look at Europe, everybody's saying, look, we need to move our defense spending from 1.5% of GDP to 3.5% of GDP. Now, for me, to a large extent, military expenditures is precisely the kind of expenditure that typically give no return. You buy a bunch of weapons that you hope you never have to use. But if you're using them, then you've got an even bigger problem. And so I think it's really no coincidence that in the post Cold War era, following the fall of the Berlin Wall, defense spending pretty much went down all around the world, and so did inflation. I think we're now looking over the coming years at a world where budget deficits almost everywhere will be bigger. They'll be bigger because governments will spend money on defense. I think they'll spend money on updating their electricity grid, which, granted, that could be productive. And then they'll spend money on building a lot of commodity, as Dr. Nungsari just highlighted, building, or as you pointed out, putting stuff in pantry, because everybody's going to need to do that. And so between the three, growth, inflation, rates, to me, what's most obvious is we're entering into a structurally higher inflationary environment, which should mean structurally higher interest rates. And then from there, it's, what does that mean for growth? I think you have the countries that today have a lot of debt, and if you end up with higher interest rates, that should be a break on growth. If you start off with a lot of debt, the countries that are coming into this without too much debt should perhaps be okay even if interest rates go up.
Okay, Dr. Nung, building on what Louis just said about higher interest rates, higher costs. So for firms making long-term investment decisions, efficiency still matters for them. But now access to energy and critical inputs, they matter as much. So given what you said earlier about Malaysia's position in ONG and Malaysia's domestic oil production is gradually declining, how should we think about attracting investment in a world where energy is no longer cheap or even guaranteed?
Now, I've always thought that I think I've always thought of the Malaysian economy as having two engines, and although the two engines are not really connected to each other, they're connected to the main body of the economy. And I think there's some distortions arising from rents on the resource side, and then you have this ABI-based manufacturing. But at the same time, I think more than just energy, this is your question. I think we need to make clear to investors, to put capital to decide on investments, whether on either side of the engine, about the pricing of inputs. Like the distortion is not just distortions in the pricing of, say, gas and therefore electricity, but also for pricing of other things, other sector markets. Labor is somewhat distorted in Malaysia, so the pricing is not needs to be properly resolved in terms of what is the real equilibrium at the labor market. I think capital has been fluid enough. I think one would assume that there's the more efficient factor market, but labor certainly has to be priced properly. And there are other inputs like energy, and that needs to be properly priced, also to remove some of these distortions so that investors can actually decide truly on what the input prices are. And nationally, we always make a big fuss about we having a low wage regime, and enacting a low wage regime, an outcome actually distorting factor prices. So I think not just energy, but also the labor market, as well as other inputs that goes into investment and therefore production decisions, and that includes not just energy lah. I think the labor market distortions, all this, which means actually we need to look carefully at the whole subsidy regime, right? Because it's highly distortionary. Right? You look at Malaysia on Budi 95, on RON 95. Now everybody in the country is paying 199 per litre when the price is what? The government subsidized more than twice what consumers pay, and it's not altering behavior at all, even during the crisis. It's made known to everybody that we had supplies, reserves of crude oil up to June, but the consumption of RON 95 has not abated at all, even though it was reduced from 300 to 200 litres. So it's not altering behavior, it's not altering decisions by households or by folks. Those are the kinds of distortions that need to be removed, but it has to be done in a way that is, it's not so painful, in order to get investors to make the right calculations to decide to invest.
Okay, since you're talking about subsidies and fiscal, let's move to Louis. So from an investor's perspective, how should we read a government's fiscal behavior in this environment? What are the 2 or 3 things that a state is acting, that you see that the state is acting with really genuine strategic intent, or rather than simply responding to all this short-term pressure?
Yeah, I think for me, and look, here I'm talking as an investor, and we invest, we spend a lot of time investing in government bonds, both in emerging markets and in developed markets. It's a big part of what we do in our firm. And for me, one of the rule of thumbs, what I always start to get worried is when I see the share of borrowing that a government does coming in from abroad. So, if the Malaysian government is borrowing mostly from Malaysian citizens and from Malaysian pension funds and from the Malaysian sovereign wealth fund, then I really don't worry about Malaysia. Because the way I always put it is, if I borrow $100,000 from my dad, as a family, we don't really have any debt. And so, for me, when countries start to get into trouble, is a lot of people look at debt to GDP and those kinds of, but to me that's not the right alarm signal. The alarm is when you start to see more and more on the borrowing coming from foreigners, because then that's not sustainable. Then that at any one point, investors may turn around and say, why do I own so much Malaysia debt again? And the country becomes very vulnerable to any kind of bad economic news, an exogenous shock that comes out of nowhere. If there's an energy crisis, for the sake of argument, as there is right now, people might turn around and say, do I want to own so much in India? Now, India is a good example. India is a huge loser of an energy crisis that's unfolding. But when you look at the structure of Indian debt, it's pretty much all owned by Indians. It's not really owned by foreigners. So, I don't really worry about an Indian debt crisis. Now, what's fascinating to me today when I look around the world is the countries that have had a growing percentage of their debt owned by foreigners. This time around, it's not in emerging markets. This time around, it's in developed markets, and more specifically, it's in the U.S., it's in the U.K., and it's in my own country of France. So, you asked me what does my checklist look like, and how do I get worried about a fiscal behavior in this environment? Across emerging markets today, you can always find examples of countries that have leaned too far above those keys. But across most emerging markets, actually, the situation is not that bad. And most of the governments still manage to fund themselves with their own domestic savings. So I'm actually not too worried. I think there's this flexibility on that front.
Okay, so essentially fiscal room gives the state the ability to act, but it does not really tell the state where to act. So with that, Dr. Nung, let me turn to industrial policy. So one of the hardest part in deciding where to focus industrial policy is because every sector can make a case of support. And with the global supply crisis making the choices even harder, how should Malaysia decide where support can build future competitiveness rather than only cushioning whatever pain we have currently?
Let me start by affirming what Louis just said on Malaysia's, on the general principle that he alluded to. I think Malaysia's resilience on the fiscal side, especially our current account surplus, the savings investment surplus is still there, and we're able to finance debt primarily from domestic savings. So I think that gives us quite a bit of resilience. And people like Louis, who goes around looking at sovereign papers, acknowledge. I think, but yet we still need to manage the fiscal position carefully in order to retain, to manage both the budget as well as the cost of existing debt. Now, going to this industrial policy thing, I have a somewhat, I look around and I think emerging market, or what was the emerging market 30, 40 years ago, 50 years ago, people always cite, I don't look at Japan as an emerging economy. Japan, even 80 years ago, it was already a developed economy. But if you look at the emerging economies that end 50 years ago, I think only perhaps Korea and Taiwan has actually succeeded in targeting that industries. The Hyundais of the world, the chip industries in Taiwan. So, and then Malaysia has done quite a bit of its own industrial policies, most of it not quite successful. So, I'm an old-fashioned sort of an economist who who believe in clear demarcations of what private and public goods are. But therefore, I believe that actually quite a bit of fiscal resources ought to go towards addressing safety nets, whether for households or for firms being affected by transitionary emissions. So, safety net, but safety nets for firms, but also safety nets for households, which actually hopefully will enable to spend fiscal resources on those things, ensuring that certain floor that people take risks and people are able to explore new things, especially for firms, which is what we need. So I think fiscal resources ought to go, to say, I mean, to use the father's son metaphor we use. I'm just telling you, son, go out there and try to do things. You screw up, you can always come home. There's always a home, food on the table. Don't take risks. So I would rather spend my resources to make sure that my house is okay, food on the table. If my children go up, I'll come back or hurt and injured, they still can survive. And they can go out again and take risks and do new things. So I would spend, from the metaphorical fiber, I would spend my resources to ensure that my children can go out there and take risks and do new things and create value. And I make sure that they're okay if they screw up. I wouldn't tell them exactly what to do. If they need to have stronger muscles, maybe I give them better food.
Okay, so Louis, if you're looking in industrial policy from the market's lenses, so industrial policy, they may build long-term national capability, but markets, they do not really always capture that value. So how should investors think about countries where, when you have all the macro strategies improving, but the value is not really reflected in markets?
Yeah, I love the father and child analogy that Dr. Nung just presented. And I'll pick up on that if that's okay, because I think it's a great way to frame it. Look, I think when you're a government, you essentially have three levers to pull on, right? Four levers to pull on. The four levers are the cost of capital, the cost of labor, the cost of government, and the cost of energy. Now, these are really the four things that any government can have massive influence over, and that are going to drive your industrial policy, that are going to drive industrial investment or not. Now, the first obvious one is the cost of government. And I think what matters the most to entrepreneurs, to CEOs, is visibility. So the first thing is, I think, when you're running your government, is making sure that the rules are well established, the rules don't change arbitrarily. Entrepreneurs, if you're making industrial investments, these are investments that are going to last 20 years. And so you want to make sure that you're operating in a framework that is understandable and that that people have faith in. So that's the first thing. And I think at this stage, most countries in emerging markets believe that. But look at Indonesia as a recent example. You have a new president coming in and saying, "Hey guys, I'm going to change the rules on this. I'm going to change the rules on that," and immediately, I think both foreign and domestic investors kind of panic. They say, "Oh, you know what? This feels a little bit like Suharto in the old days, where like you change the rules at a moment's notice. I'm just going to hold back and not invest." So the first thing is, when I say cost of government, it's not just your taxes or your regulations, but it's really the predictability of government. And I think this massively impacts the cost of capital, which is, of course, your second lever. Governments that are predictable, that are stable, tend to have a lower cost of capital. And so to have a successful industrial policy, you must first have a successful fiscal policy, because that will bring down your cost of capital. I think the energy policy matters tremendously, and it's probably going to matter more in the next 10 years than it ever has, because you're going to start to see massive differences in the cost of energy around the world. The days where essentially everybody was feeding off the same oil price and the the same natural gas price may well be behind us. And you're going to get huge divergences in the cost of electricity and the cost of energy, depending on whether you made the right investments and whether you made the wrong investments. So today, China now produces more electricity from renewables than the US produces electricity, period. And the cost of electricity in China is now less than half that of the US. That now gives China a comparative advantage, of course, vis-a-vis the US in most places. And then finally, there's the cost of labor. And I think that matters tremendously. And this is where, again, governments can have a big impact because deep down, that comes down to exchange rate policy, right? Do I want to try to maintain an undervalued currency, which is how Taiwan grew, which is how Korea grew, which is how China grew. It's you maintain an undervalued currency and you essentially favor your producers versus your consumers, and you favor domestic industrial investments. So again, four levers to pull on when you think of industrial policy. And I think if you're going to be successful, you need to pull on all four of them smartly. But the one where, of course, you have the most impact as a government is the cost of government. And that means being very, very transparent and explaining to the market well what you are trying to achieve.
Okay, let's stay with you, Louis, since you mentioned on China. You have written that the US is trying to out industrial policy. China is like stepping into the ring with Muhammad Ali, and you do not beat Ali by becoming Ali, right? So even if the world's largest economy struggles to compete with China on China's term, what should middle powers do? How should they coexist with China and still build their own industrial capability?
I can't believe you managed to dig out that quote. But yeah, of course, the first point I'd make, of course, is the U.S. is not a middle power, right? And when I said like the U.S. shouldn't try to play China in China's game, I meant that China has itself the U.S. has massive comparative advantages that it can play to. It doesn't need to go into the boxing ring with China on China's terms because it has so many other things that the U.S. can do. And to your point, so many other things that might not be open to a middle power. And so, look, to answer your question, if you're a middle power like Malaysia, how do you compete with a China? How do you catch up with a China industrially? And here, I'll be honest, I think it's a very tough proposition because if you look at today's starting point, again, going back to these four levers of power, China today has the cheapest cost of capital in the world. It just has the lowest cost of interest rates. It also has one of the cheapest or pretty much the cheapest cost of electricity. It also has one of the cheapest cost of labor if you adjust it for productivity because they have the cheapest currency. So if you look at the starting point, you're like, how do I compete with the guy who's got the cheapest cost of capital, the cheapest cost of electricity, the cheapest cost of labor, and the cheapest currency? I'm not going to be able to compete with them on the cost of electricity. Actually, Malaysia might because Malaysia is gifted with a lot of natural resources, but most countries it's going to take them 10 years to invest to the scale that China's done. So it probably won't be able to compete on the cost of electricity, won't be able to compete on the cost of capital. So the one place that's left is really competing on the currency and the cost of labor. So I think today, if you're a middle power like Malaysia and you think, okay, we want to have a big industrial base, we want to compete with China on industry, the only way you can really do it is by maintaining a very, very undervalued currency and in essence, penalizing the consumer to benefit the producer, which again is what Korea did for years and years, what Taiwan did for years and years, what China did for years and years. It's really penalizing the consumer to benefit the producer. And that's a political choice. And you might say, well, that doesn't make sense either politically or economically. We're now past that stage as an economy. It's a political choice that I guess a country like Malaysian policymakers have to debate. But you're clearly not going to outbeat China on the cost of electricity or on the cost of capital. So those are the only levers you have left to pull.
Okay. Dr. Nung, let me bring that back to Malaysia. Louis, he made a point that middle powers bit tough for them to compete with China on China's term. So for Malaysia, what does smart engagement with China look like? how do we work with Chinese capital and technology while ensuring Malaysia firms, they really build their own capability?
On the big ones in manufacturing, I think the fierce competition in China, you learn from first year microeconomics. So the Chinese firms, average cost curve is so low and so long, elongated, because they operate at a certain scale and the result of such fierce competition. There's no way anybody could beat them on cost and scale and competitiveness like that. So I think the issue going forward is, if you think about whatever the outcome would be, the new thing, I think the positioning is actually we have to think of ourselves as living in the land of giants. Of course, there's all these few giants in the world, 3 or 4 giants, continental economies. US, North America, and US have decided to kick out Canada. So actually, US, Europe, Russia, and China. So our strategy should be about nimbleness, about specific relationships at the firm level to ensure some sort of scale and competitiveness at the firm level. By a firm versus firm sort of relationships, and to exist in that manner with the surrounding giant. I mean, there is also a giant next to us in the neighborhood. Indonesia is a much larger economy, population than us. So it's about, that's why I say the imperative going forward regionally is actually more of integration. But the problem with ASEAN is actually ASEAN economies tend to have similar structures of production vis-a-vis the external market, non-ASEAN market. So we need to build more firm-to-firm relationship within the neighborhood. Then we can have better leverage in our relationship with the giants, the other giants externally. So it has to be firm-to-firm level relationship regionally, as well as firm-to-firm relationships with the giants out there in the world. I think that should be the strategy. We can't compete on head-on on whatever technological advantages that the US have, or what Louis said about the cost of energy or the cost of capital in China, or if you translate it into cost curves. Nobody can compete with China on their cost curves on the things that they do. So the other option is actually to look at new things. If it's a new thing, then actually you have a better chance of working with somebody to be part of the new thing. But if it's about more of the same thing or doing better the same old things, that sort of game, I don't think should be the kind of thing that we should be focusing on. And unfortunately, I think the new economic regime would force us to do adjacent stuff from what we're already doing. And I think those are the kind of things that we should focus on, firm to firm, building on what we know, or doing something totally different.
Okay, since we are on ASEAN right now, so Louis, how are markets pricing ASEAN right now? If the energy crisis is increasingly an Asian crisis, given the region's dependence on imported energy, what does that mean for ASEAN equities and capital flows?
Yeah, look, first, an energy crisis is good news for no one, right? It's an energy crisis, and the Iran war as it's unfolding it's just bad news all around. So that's the first important point. And yes, it is bad news for ASEAN. I don't know if you saw yesterday's Philippines inflation numbers came out at 7.2%. I think it was expected at around 4.5%. So it came out to much higher than expected. And I think you're going to see the same type of numbers in Indonesia and in Vietnam and in a number of the regions major economies, the Filipino central bank came out and said, "Hey, look, we're definitely going to be hiking rates very soon." So, so already you're seeing a shift towards a tighter monetary policy. I think you're going to see a shift towards a tighter fiscal policy. So none of that is great news. None of that is great news. Again, like an energy shock, economic activity is energy transformed at the end of the day. So a higher price of energy is sort of bad news all around, unless you're an energy producer. So Malaysia's an energy producer. So Malaysia within that, the ASEAN framework should be the sort of brighter light. Indonesia also, to the extent that it exports coal and some natural gas. But let's not beat around the bush. This is not good news. I think there's behind that, there's another factor that we have to consider, which is that if you go back to just a couple of years ago, the mantra amongst investors was ABC. You remember ABC? Anything but China. And the idea was that new investments, new factories, etc., would go to other places. They would go to Vietnam, they would go to Indonesia, they would go to Malaysia, Thailand, wherever. It was ABC, anything but China. And now I actually think, now, we're going to see how sticky this ABC mantra is, because you have President Xi and President Trump that are meeting 4 times in the next 12 months, which is highly, highly unusual. To have the Chinese and US presidents meet 4 times over 12 months is kind of unprecedented. And you have to think they're not meeting to discuss the Soccer World Cup or the weather. And my take on the Iran crisis is it's obviously a global inflationary shock, and that means that President Trump will probably be very eager to get a deal done with China, because one of the few ways he can get inflation back down in the U.S. is by getting a deal done with China. Now, so if you get an improvement in the U.S.-China relationship out of this, and I think the odds of an improvement in the U.S.-China relationship are actually pretty high, because today the U.S. needs China for the rare earths, it needs China for the magnets, it needs China for the solar panels. Meanwhile, China actually needs the U.S. for a number of things as well, most specifically the semiconductors. So if there's enough there to have some kind of deal and those guys to get along, then it kind of leaves the whole ABC thing out in the cold, and it does leave ASEAN a little bit by the wayside. So yeah, unfortunately, nothing that's happened in the past sort of 3 or 4 months is I think that great for ASEAN, I'm sorry to say.
With that somber note, thank you, Louis and Dr. Nung. We have covered a lot of ground, and I'm sure many of you have questions. Let us now bring questions from the audience. Okay, first question. Okay, what strategic steps must Malaysia take to ensure that we genuinely move up the value chain into innovation, talent, and high-income industries over the next decade? Go with Dr. Nung here.
Well, we have to overcome. It's up to people who have capital. I think quite a bit of Malaysia's internationally competitive industries. I mean, not the FBI one. The resources, land-based stuff are rents. Rents. If you have capital, you probably want to put capital when there's not only profit but there's economic lens, and that's, I think, one of the challenges for investors to put money in new things. And if you lament this business of high income, and then you have to put it in new things rather than in more of the same things. I don't think you can even put money in better ways of doing the same things. They are of the same industries, but you should try to put them in new things. But new things, people like Shafizal, in Khazanah, they would do their spreadsheet and whatnot. They will say, on the risk-weighted basis, to put money on the new thing is riskier than to put money in doing more of the same things or doing better the same things. So the challenge is actually, I think, entrepreneurship and innovation. That's why I advocated my position earlier, is to ensure that the safety net is there. If the safety net is there, perhaps people will take more risks. And if they take more risks, then they'll be more innovative, they'll be more exploratory, and hopefully they will find things that are more competitive and be better returns on innovation rather than returns that's based on rents.
Okay, so next question.
Actually, can you get something? Sorry, because I think it's a super important question. And I agree with everything Dr. Moon said. But I'd add just an idea to it, which is that if you go back 30 years ago, why did all the back then the Motorola's or the Dell computers, etc., why did they come to China? They came for two things. They came for the cheap labor for sure, but they also came for the promise of a big domestic market. And they did joint ventures and they brought in their know-how, they brought in their expertise, and which allowed China to grow. And so today, if you're in Malaysia, you could say, well, what can we offer the big multinationals? Why would they come into our markets? And so one option is indeed, like I said, you keep your currency cheap and you make your labor cheap enough. But the other is, I think you have to make the promise of a big enough domestic market that is interesting for foreign investors to participate in. Now, Malaysia by itself might be too small, but the whole of the ASEAN is a potentially huge market. And so one path towards growth is further economic integration in ASEAN, where a Dell computer says, you know what, I'll build my factory in Malaysia. And from this factory, I can sell my computers into Indonesia, into Thailand, into Vietnam. I can service the whole region seamlessly because the regulations have been streamlined, because the free trade has been streamlined, so on and so forth. And that's really, I think that's ASEAN's selling proposition. That's the comparative advantage that ASEAN has to do a better job presenting to the markets, saying, look, whether you set up in Thailand, whether you set up in Vietnam, whether you set up in Malaysia, we're going to make it easy for you to sell all across the region. And then you become attractive for foreign investors to come in, bring in their expertise and help you raise your game.
Okay, thank you both. So the next question will stay on industrial policy. So if the government's role is to set the framework, cost of capital, energy, labor pricing, policy stability, how should Malaysia sequence reforms to its subsidy and wage regime without triggering a political backlash that undermines the very stability investors are pricing in? Start with Dr. Nung.
Well, that's a full of a question. I'm trying to look for where. I think the question is more on sequencing, is it? Sequencing
How
of
should
the
Malaysia sequence reforms to its subsidy and wage regime without getting political backlash?
slowly. But that's the problem with doing it slowly. Like you end up not doing anything. But I think if people realize and come to terms that they have to decide whether they want to pay more taxes and therefore increase the revenues to allow for subsidies, or if you keep revenues to be the same, fiscal revenues to be the same, then expenditures will have to be reallocated within that. So, for example, if you want to subsidize, you want $1 per 99 cents, around 95, then you have to have less of something else. Is that what you want to do? So then, or do you want better safety nets, or do you want better investments in new capacities? Public investments. So I think there should be I think there should be an understanding. Then there should be an understanding of trade-offs, and then we do the trade-offs. Now, in terms of the four things that Louis mentioned, I think fiscal discipline is important because it defines the cost of capital, cost of government, in terms of belief in the institution, transparency, and so on. Then my other point is actually to look at Louis said that exchange rate will then define some macro sort of thing. I think the experience in Malaysia, we tend to be after 98. What was it when we opened up the capital markets again in 2004? We don't quite play the exchange rate game, and in some sense, the ringgit has been a bit stronger than expected over the last, say, 12 months. But in terms of government, cost of capital, cost of government, visibility, transparency, and then I think energy, we need to really decide. There was the launching of the national new energy transition. What was it? Shafizal and ERP, right? New the energy transition roadmap. So we need to decide. And then there's all this climate change business. The only thing that's non-carbon that we generate electricity on is actually hydro. And global warming has actually affected water supplies. And we need to think carefully. We're in the equatorial, solar is not quite the thing for us. Perhaps we should go down the road of Japan and other more efficient economies and use less of energy. We surely need to use less of energy. I like to quote that actually with 34 million people, we register 800 over 1,000 new vehicles every year, which is ridiculous. So efficiency can be a road that we should take apart from conservation and looking for alternative energy sources. So in that order, or maybe simultaneously.
Okay. Next.
So I would say, okay, go ahead. Sorry.
Okay, just building on what Dr. Nung just said. So on energy, could cheap electricity become the most important competitive advantage over the next 20 years?
I think it is. And I was about to say this actually. In terms of sequencing, I think getting your energy policy right is going to be the most important thing. I think today that's China's single biggest comparative advantage. To be perfectly blunt, I think because China's gotten its energy policy right in the past 10 years, it is one of the reasons that China now has the lowest cost of capital in the world. You get your energy policy right, the market rewards you with a low cost of capital. You get your energy policy wrong, then you end up with higher inflation, a less efficient economy, an industry that struggles. This is where Europe, of course, is today. So getting your energy policy right is extremely, extremely important. And yeah, look, in 20 years is a long time. But I would say for the next 5 to 10, I think that's going to be the most important piece of the puzzle.
Dr. Nu, do you share the same view?
Yeah. I think the other thing that we need to do something about is the distortion in the labor market. I think our labor market, because it's somewhat quite distorted. I mean, I'm really sick enough to accept that we would have to be, foreign labor, but we have to price labor properly. The application of labor laws to all labor, and to accept everybody who works as labor, doesn't matter who they are, where they come from, and therefore price labor properly. And therefore, firms will then be forced to have a proper accounting of their costs and what is doable, what is feasible, and so on. So apart from energy, I think the other major distortion in nature is actually the labor market.
Okay, thank you for all the questions. As we come to the end of the session, let me bring the discussion back to where we started, the return of the state. If governments are being asked to do more, the real question is what capabilities will matter most in the age of economic security. To close, let me ask each one of you for your one final thought. So Louis, let me start with you. Do you have anything to leave with the audience, about 1 or 2 minutes?
Yeah, well, first, thanks a bunch for having me. I really enjoyed this conversation. And look, I hate to beat a dead horse, but for me, what is going to really matter, and this Iran crisis really illustrates it. It is having an energy policy that makes sense. And here, I think this is where we can be optimistic for Malaysia, because Malaysia has lots of options when it comes to energy. Of course, Malaysia is a big natural gas producer. It is an oil producer. It benefits from nice weather, and the cost of producing electricity through solar keeps on plummeting. And so solar panels are an option for Malaysia. So Malaysia, and there's the option of biofuels. Like Malaysia has lots of options. And so I would leave on an optimistic note. I know I sounded a little bit downbeat on the ASEAN and highlighting that it's tough to compete with China. But within ASEAN, I would say that Malaysia today perhaps is the bright star in that it does, it does have energy options that other countries do not have.
Dr. Nung, bringing back to Malaysia, what is the one thing we cannot afford to get wrong over the next 5 years? And
I wanted to say something. I think the premise that the government is returning, the state is returning. I think the state never left actually, but the role of the state. I think maybe I'm a creature of what I went through in 80s, 90s, and so on. I think there should be clear demarcation between what state should be doing and ensuring minimizing the cost of transition and friction, as well as providing a safety net for those affected by those transition is crucial. And the state's role in building capabilities and new capacities through investments or through other means is essential and needs not be traded off for other things. But yet at the same time, we need to actually change the mindset of Malaysians that we can't look at a 34 million economy market with a 6,000 to 7,000 ringgit median household as the demand side. We need to broaden that to include parts of Indonesia, parts of Thailand, parts of Singapore. And I agree what Louis was saying. It's in the market is too small for the firm to be resilient, sustainable, and competitive. So we should change our mindset and embrace our neighbors more. Hopefully, they embrace us.
Louis, Dr. Nung, thank you. So we opened this session with the image of supermarket and the pantry. And for many years, countries could rely on the global supermarket to provide what they needed and when they needed it. And today's discussion has shown that resilience now requires a more strategic pantry of our own. And if there's one idea we'll take from this session is that economic security has become a test of state capability. It'll be measured by reliable energy, reliable fiscal choices, industries that can hold their place in global supply chains, and also capital with the patience that support them through the cycle. And return of the state does not mean the state has to do everything. It means the state must know where it matters most, and firm must invest with longer horizons, and market must begin to value resilience as a sort of value. To both Louis and Dr. Nung, thank you for the generous conversation. To everyone joining us today, thank you for your time. And before we close, we would be grateful if you could share your feedback by scanning the QR code on the screen. We look forward to continuing this conversation through future KMF Reconnect and also at the annual Khazanah Megatrends Forum. Thank you, everyone. Have a good day ahead.